index is up about 0.25% sectorally speaking. The Nifty at about 23,500 now. So that's a 100-point cut now. So 0.25%, that's in line with what the Nifty Bank is opening up so this morning. So that's essentially the overall picture, at least at the index level. The heat map should come up on your screen. It'll give you a sense of how we're likely to start. And at least on the Nifty, how many up and how many down in a bit. But let's get straight down to stocks. Survi.
Yeah, and before the Nifty stocks, Prashant, just if we can bring up Zaggle once. I think on my screen at least it's showing down 10%. Let's see what the traded rate is. Yeah, Zaggle's down 10%. One of the reasons could be that, the operating expenditure has gone up 70% and the market cannot ignore these kind of things. And the margin has come under pressure quarter on quarter, year on year, the margin compression, even the adjusted EBITDA margin is down over 200 basis points. And all things put together, the new logos are great, the top line growth is great, but margin is falling and OPEX is up 70%. The market doesn't like it. That's the sum and substance of it. And the other stock that we mentioned, V8, of course, is doing really well, about 11% up. On the Nifty, the cut is now 80 whole points. So let's see what's taking it down. Some of the global-facing stocks are nervous with all this tariff talk happening. JSW Steel, Tata Steel, all of them are on the lower side for the starting point at least. There's Cipla, there's Hindalco on the lower side, there's NTPC, there's Dr. Reddy's. The Bank Nifty is not offering much support. We saw that on Friday as well. I mean, all excitement on that 25 basis points rate cut completely fizzled out, didn't take the market anywhere. HDFC Bank is on the lower side to begin with. Let's see where ICICI and SBI are, also lower about 0.25%. State Bank is the one that's an exception. It's up about 0.5%. Reliance is the other big stock that's taking the market down. There's Maruti, there's Nestle. There's a lot in the mix on the downside. In fact, on the upside on the Nifty, BEL and M&M, which is sort of great performance, and we'll be speaking to the management soon. That's the one that's up. And there's maybe Britannia and iShares. But apart from that, only 3-4 positive names on the Nifty. Otherwise, some pressure.
Well, that's right. And from the broader market, just a couple of stocks. Reliance Infra, the stock is up close to 5%. They announced that settlement with the CPL of around 6,500 crores. I think it could be a book entry. For the time being, though, that one is up close to around 5%. And it was up close to around 6-7% even on Friday. So that's one of the top volume movers. On the flip side, actually, we have Jyoti Structures that's down close to around 15%. So that's one of the top volume movers. SCI is down close to around 5.5%. Ola Electric posts its numbers. That stock as well is lower. And the other one we pointed out earlier today was ITC Hotels. Massive volumes last couple of sessions. Got exited from the Sensex as well as the Nifty. Well, for the time being, volumes very, very high on that one. The stock is up only 1%, but volumes very, very high for the first minute of trade.
All right. Sorry, go on.
Well, that said, let's welcome our guest. We have Nitin Bhasin, Head of Institutional Equities at Ambit, who joins us on the show. Hi, Nitin. Good morning and good to see you. And I believe you're joining in from Boston. And the million-dollar question out here is, what's happening with the FIs? They have been selling lock, stock and barrel. If you wanted some support from the government, you got it in Budget 2025. The RBI obliged and cut rates. And the BJP appears to be on a firm footing, particularly with that win in Delhi. What's your take? I mean, what's the interactions you've had? Do you expect the flows to come back to India?
Good morning, Nigel. Pleasure to be here. Good morning. Yes, joining in from Boston. Last 1 week of meeting global investors, many of them. Actually, a lot of them are finding India becoming attractive after the last month or two of correction in terms of especially mid caps and the small caps. Most of them have actually been investing in India in the last 1 or 2 years in mid caps and small caps, but found valuations expensive. Some of them have either gone underweight or some of them have reduced their overweight, keeping an eye out for good quality companies which may be available with attractive valuations given what's happened in our country in the last 1 or 2 months by FI selling. So we got a sense that overnight or in the near term, the money may not be coming back very soon into the mid cap, small caps by the FIs, perhaps waiting for a little bit more direction from the macro and correction in valuations.
Hopefully they don't sell as much though. If they're not coming back, it's okay. But they have been selling, very, very aggressively. Okay, talking about the macros, let's talk about Budget 2025. It had something for the consumption names. Capex, maybe a little less. How are you all viewing this? And would you all recommend switching portfolios around, tilting more towards consumption names?
Exactly. I think, one of the big questions that came across in this entire a week of meetings with the global investors was that, what's happening to the consumption in India, how to read the budget given the government's perhaps very muted investments on infrastructure investments. So what we also highlighted on the day of budget in our strategy note for the investors was perhaps it is the time right now to look at some consumption names which will get benefited from the income tax cuts. We were expecting closer to about income tax rate exemption to all the way to million, but I think the government has surprised everybody by going to 1.2 million rupees as the starting income tax. I think consumption clearly, which helps, middle of the pyramid, bottom of the pyramid, discretionary, slightly, electronics, durables, we find, and even entry-level motorcycles, and to be benefited. So hence, we have advised investors to increase slight weightage in consumption names from earlier, where we were overweight on IT. We have reduced our overweight on IT to go more towards FMCG consumption right now, and perhaps pull back a little bit more on the capital goods and construction names.
Nitin, hi, morning. So when you say, go a little more overweight on consumption, are you referring to staples or discretionary? And staples, do the valuations not bother you, given that growth is still single digits, low single digits in most cases? Are you okay with the valuations?
So clearly, we've been highlighting for the last month or two that we think in the times like this today, when there is an earnings uncertainty, we have a deceleration perhaps in the Indian economy, markets would actually tend to move towards more quality companies and more mega cap companies. That was what I was highlighting to you about a month back also, that we believe that the perception on the quality factors is more towards FMCG, followed by IT and some bit of other consumer discretionary names. So it's less about the call of where the valuations are today. I would actually say that it's more about where there is an earnings, perhaps less possibility of cuts. Consumption earnings anyway are not supposed to grow very materially. So hence, I would say that our team believes that perhaps one should be more towards consumption, very well knowing that in India, many things are expensive, but we have to look at where is the earnings risk least perhaps to be over there right now. Quality factors.
Okay. What about financials, Nitin? We've seen the RBI policy. It's on like expected lines. The 25 basis rate cut has happened. More promise of liquidity measures if and when needed. But the entire BFSI space is not quite enthused. What are you doing here?
Clearly, we are also the same camp like many others out there, that the earnings perhaps are looking much good for the banks right now as compared to many other sectors in India. Hence, we have been highlighting that we should be overweight on banks right now, because clearly, if you look at the share of profits versus share of market cap, so completely in stark contrast to what's happening in the small caps in India. So we have been advising for a while now to be overweight on banks, especially banks like SBI, banks like Axis Bank, followed by ICICI Bank. So very well knowing that ICICI is a punchily valued stock right now, but we find comfort in valuations of, let's say, an SBI. So banks is something we are advising overweight, not so in the NBFCs, given that we see that there are credit risks in many segmental NBFCs.
Okay, by the way, the market seems to be listening to you. There's some recovery in the large cap space, and the recovery is coming in a lot of consumer names, actually, from the opening lows. Britannia, for instance, is 2% higher. There's buying in ITC. Then you have names like Lever, which are looking better. And even the financials, they're stabilizing. There you see the charts. How the stock started pretty low, and then now we're looking at some green over there. And financials also, the bank Nifty itself, Nifty Bank, look at that. It's a smart recovery that's underway. SBI is leading it, but even other names like ICICI Bank are pulling back. IndusInd Bank also at the flat line. So good recovery in financials. Nitin, so finally, you're saying that there is a lot of interest in FPIs and, they're finding India more attractive, but we're not seeing the money come through. So, what's the tipping point?
I think valuations and perhaps seeing what happens to the small cap and the mid caps, because the fact that in the last 2 years, a lot of funds flow in India, whether it was domestic or whether it was international, has come into the small cap and the mid caps, where the valuations have become very, very punchy, very, very, I would say, unattractive to make money. They're all aware, they all understand that the base rates of returns in the market are not very high if one was to look at the last 9 years of performance in the Indian market. So clearly, where interest on India, because of its high 6.5% to 7% GDP growth over the next decade or so, the large population, China plus one, many themes work for India. Presently, many of them find valuations expensive and hence either reducing their overweights or going underweight. And that too, especially, I would say, in the large caps and the mid caps. Oh, sorry, in the mid caps and the small caps.
Got it, got it. So valuations are still a spot of bother. Take that point. And I think that's what the market will have to deal with, at least in the near term. Thank you very much for joining in and giving us perspective on how things look here in India. Well, with that, let's move on. The story, of course, is the market's trying to pull back, and there's a bit of a recovery from the opening low. So it's looking better now for the Nifty. The next company and stock on our radar is actually Akzo Nobel. Now, the Akzo reported another muted quarter, which is no different from most other paint companies. Moderate volume growth, pressure on margins because of raw material inputs, etc. But the more interesting aspect is what is happening with the business reorganization and the slump sale of the industrial paints business to the parent that's in the works. To talk about this and the further business plans, we have with us Mr. Rajiv Rajagopal, Chairman and Managing Director at Akzo Nobel. Mr. Rajagopal, thanks for joining in. Let me start with the decorative paints business first, because that's all official. And we keep speaking to a lot of your peer companies and who's interested and who's not. But where are you on the sale of the decorative paints business?
Good morning, Surabhi. Good morning to you and all the viewers. First and foremost, as far as the entire strategic review is concerned, I still think we are in fairly early stages, really. And at this point, I've nothing really to comment on the transaction or the scope of the businesses within the transaction, except what is already in the public domain. I mean, you've got to appreciate the fact that given my role, obviously I get information, and when I get information, that has to first go to the board, to the stock exchanges, our employees and our partners and distributors, given the sort of scope. At this point of time, it's a global strategic review. I think there are various reasons and as I said earlier, the idea was to see how can we catapult the brand, to a top 3 position, which is what we aim to do globally. So that's really why we sort of initiated this. I understand that we are in the early stages, and as and when we have something material, Surabhi, I'm sure we will come back to you.
No, absolutely. I understand that, Mr. Rajagopal, that it'll have to go through the due process. But what we're just trying to get at is whether bids have been received, and typically, what is the timeline that you're working with for this strategic review to happen? If you could also just throw some light on the other piece, which is the sale of the coatings business and the industrial business to the global parent. Where are we on that?
So again, both are running parallelly. As far as the bids are concerned, I mean, honestly, that's something that I do not have a clear update on, and it's not fair for me to sort of speculate at this point of time. There is a process. How long will it take? It could take anywhere between 6 months to 9 months, the way I see it. Could be faster, depending on how quickly certain parts move. On your question so it's not the entire industrial coating. If you see the announcement, that was limited to powder coatings, where we are a global #1 player. And so we've sort of segregated the liquid and the powder coatings business and our international research center. Now, the international research center in Bangalore supports our automotive and specialty coatings business. They basically what they do is we produce colors for all the automotive brands, including the McLaren Mercedes F1, with whom we are engaged. So those are the 2 businesses that the global parent has asked to sort of look at. As far as, the process, again, there is internally as Akzo Nobel India, we reach out to SEBI-registered players, and we are trying to seek a valuation, which should take a couple of weeks. And as soon as that comes in, again, we will have to go to the board. So, Surabhi, the only point I'm saying is these things take time because, we want to do it in a fair manner. As I said, the endeavor is not to rush it, and we have to follow certain due processes in this. And I think also while doing it, we have a business to run. As you see.
No, exactly, Mr. Rajgopal. Coming to that, I mean, if we can get some more clarity on the businesses that you will be left with once these two strategic processes are over, which you're saying could take 6 to 9 months, and then what's the thought process? I mean, whatever is a residual business, will the entity remain listed, or could you look at simply delisting at some point? Is there some clarity on that?
Yeah, I mean, at this point of time, again, Surabhi, for me to sort of articulate, look, these are propositions. We have to look at what is the valuation that comes out of the, the second part. And we have to see whether it is attractive enough for us to siphon it. Assuming only that happens, the other things will fall in place. Yeah. But as far as delisting, etc. is concerned, at this point of time, no, I think we continue to be as is. We continue to run our businesses. We've given commitments to our business partners, our customers at large, that we take responsibility as a responsible company for whatever we do in the country. Our focus is continuing to, under the sort of conditions that you're seeing, and you explained earlier when you opened across the businesses, making sure we deliver strong growth and profitability. That's really the focus. And the other activities are happening parallelly. And as soon as we have something material to inform all of you, we will be the first to tell you.
Okay, all right. Rajiv, should be tried, but at least we got a timeline, 6 to 9 months and thereabouts. In fact, some of the other conglomerates have said we have thrown our hat in there, but for the time being, you're saying that you're not sure about that. We can't disclose it. We'll wait by first stock exchange filing. So got that. Let's focus on business. Could you tell us how's demand shaping up as of now? What kind of volume growth are you looking at? And what's the updated market share?
So, Nigel, good morning. If you remember the last interviews we had, and you and Mangalam were there, I had sort of clearly said that we would start getting into a mid-single digit and before moving to a double-digit volume growth. And that's what we've sort of done. I think we are now, if you look at the last quarter, both on the paints and the coating side, we've registered strong volume growth. And the reason I use the word strong is because if you look at the paints business this quarter that went by, our performance in the putty and the lower end products actually had dropped. So really, the team has done a fantastic job. In fact, we had some good performance in the premium side, which is where, which is our raison d'etre, which is the reason why, we have a strong profitability versus the other players in the industry. And that augurs well. What are we doing on the decorative side? So we continue to, bring in our products, innovations, focused on sustainability, focused on differentiation as far as decorative is concerned, and we continue to drive our distribution. We've got approximately about 160 distributor partners. Almost 90% of them are more than a decade old in the company and associated with us. So we're really proud of that. And now we moved to a hub and spoke model where we are trying to move to now 5,500, 6,000 towns as we start doing it. On the coating side, we've had very strong performances in our marine and protective verticals. So on the coatings vertical, marine and protective, we've had very strong performance on our powder business. We've seen a bit of a sluggishness in the other two, which is the automotive and industrial. But it was also related to the fact that, we have some large customers overseas and that's seasonal and that should come back this quarter. So all in all, I believe that, again, we would now move from a mid-single digit to between a mid to a double-digit sort of a volume growth. And I think it'll take a quarter or two for us to really sort of see the benefit of some of the tax benefits that the finance minister has announced. I think that we should start seeing a surge by the first or at least the second quarter of the next fiscal. We should start seeing, again, the industry getting back to a double-digit volume growth. What I'm really pleased about is that for almost now 10 to 12 quarters, we've been gaining market share. And even under these conditions, you can see that speaks volumes of the performance of the team and the focus of the management in making sure that the business is run pretty strongly.
No, absolutely. And, full marks to you and your teams for that. It's a tough environment. Plus, there's reorganization going on, but you're focused on running it the best you can. So you're saying double-digit volume growth, Mr. Rajgopal, for the industry. By which quarter?
I think by the first to second quarter of the next fiscal, we should start seeing the industry bouncing back. I think some of the other players have also given you similar time frame. I echo that. Look, if you even took at the industry and if you take a couple of new players who've come in, right, still in this quarter, the volumes are still tepid. I've been myself sort of speaking to people. We clearly feel that, look, there is a little bit of, sluggishness. We believe that what's just got announced should unlock, the buoyancy. First, in my view, the essentials, staples will benefit, and then the discretionary, particularly paint, will start benefiting it. And it augurs well because it comes just at the time of the season as far as decorative is concerned. As far as industrial is concerned, look, I think the government will now start putting the capex. I think the key elections are all over. The government obviously has been at pole position, and we should start seeing a huge amount of outlay. Because this is the critical time for the capex to come in. You will also start seeing private capex slowly coming in with a little bit of confidence coming in, which you can see this time. I mean, if you compare this quarter to last quarter,
Right.
you can see that the results have been fairly stable, and I think now it'll start picking up.
All right. I think we will have more to speak about. You'll have more to tell us over the next many quarters, and we hope we'll be able to do that. Thank you very much for joining us here on CNBC-TV18. It's always a pleasure, sir, speaking to you. The market, by the way, is down 118 points. The rupee is at 88 to the dollar. So I think we should put that up as well. We opened around 88, just about, I think, 10 paise off. We're still about 87.90. I think, okay. So did we hit a high there? We'll just check and put it out if that is indeed the case. Let's just revisit delivery here. Mangalam is back with us to shine the spotlight on this one. Mangalam, take it away.
Well, we spoke about how it was a seasonally strong quarter in which the company has reported a soft performance, and that's exactly is weighing down on the stock as well. Opened mildly in the green, and thereafter there was sharp selling. The stock is currently at the low point of trade. The revenue growth at 8.5% was much lower than what the company has been historically doing in the third quarter itself, and that's weighed down on their margins as well, which have come down from 4% to 4.3, from 5% to 4.3%. The net profit you would see is doubling from 11 crores to around 25 crores, but that's because of lower depreciation. The company 2 quarters ago had changed their depreciation method, and as a result of which their depreciation this quarter is actually lower by 66 crores on account of change in the depreciation and amortization method. What was the weak part of this quarter? Express parcel revenue, which grew just 2.4% in terms of shipments, and that's nearly 2/3 of their overall revenue, and that's weighed down on their margins as well. From 20.6%, those margins have come down by 15.6%. The part truckload business, which the company has been scaling, did good on volume growth at 16.6%, but the margins out there improved as well. The weakness in the express volume was way too much to actually be offset by good performance in PTL. The other two factors that weigh delivery down are the fact that it's the first quarterly performance that the company has reported ever since the stock has come into FNO. So fresh positions can be added on the stock on the obverse side. And the second part, there's always that hanging sword of institutions wanting to sell out of delivery, so that supply overhang continues on that stock too.
All right, Mangalam, thank you very much for that. So it's delivery in focus. First Source is another one. Reema, take it away.
So First Source has raised the full-year revenue forecast. They're now expecting the company to deliver revenues at 22%. If you look at the midpoint of the range of 21.8 to 22.3 versus a 20% kind of growth earlier. So in 3 months, they've raised the revenue forecast. The company's top line looks good. The company's delivered an 8.3% quarter-on-quarter revenue growth and a near 30% jump on a year-on-year basis. Remember, year-on-year numbers are also boosted by the Akzo acquisition that the company did. For the first 9 months, revenue growth is at a run rate of 21.8%. Margins for the company have expanded by 30 basis points to 11.1% sequentially, and the company holds on to its margin guidance of 11 to 11.5% for the full year. Even in the conference call, the company was fairly upbeat. They spoke about Q3 exit deal pipeline being the highest ever. They were confident or looking at sustaining the deal momentum going forward. Strong commentary, good performance, guidance upgrade, and the stock is holding up in the green.
All right. Thanks very much, Reema, for that. That's the picture on First Source. Markets down, and I think we're at the low point of the day, 130 points cut on the Nifty, 23,430. Let's focus on Mahindra and Mahindra. Third quarter was a healthy quarter for them. Good improvement in margins, strong volumes for the auto and the tractor segments. Tractor, especially, lots of focus in terms of how that segment is coming up over the last couple of quarters and maybe over the next few quarters as well. Let's talk about what's sort of gone on and, of course, what's the future looking like. We have Anish, Group Chief Executive Officer and Managing Director at the Mahindra Group, with us here in our studios. Anish, great to have you with us here on the program. Thank you very much for joining us.
Good morning. Great to be here.
It's a pleasure to have you with us here in person. Yeah. So that makes all the difference. Let's just start with, I want to start ahead. We look back in a bit. But 14th of February,
what a
Valentine's Day, and you're opening bookings for your EVs as well, right? What's the expectation like? And it's going to be available across, 200 plus dealerships?
It is, because we were first planning to have it with a select group of dealerships. But just given the level of demand we've seen, we've had our dealers from all around the country saying, you cannot leave us out. You have to be present everywhere. Okay. So it is about unlimited love, as we've talked about, and therefore Valentine's Day is a perfect day.
Who's the buyer going to be, in your opinion? I mean, what kind of demand are you expecting? Just talk to us a little bit about that. I mean, what's the internal sense as you open bookings here?
Based on the test drives we've done, we've seen a very, very strong positive response. And the buyer actually cuts across multiple segments, because this is a vehicle that has everything from a quality standpoint, a technology standpoint, very well priced. And therefore, it really combines a lot of attributes that a number of buyers look at. Electric is going to be something new, because this is going to be, in our view, an inflection point for the country to start moving towards electric at a faster pace.
Any numbers, projections in that sense?
What's the capacity? What is the total number of units you could sell
so
on a monthly basis?
Our capacity that we've set up is 5,000 a month right now, which is a fairly healthy capacity. And then we will expand it to potentially 10,000 as more electric models roll out over the next 12 to 18 months.
So there's so much excitement about these models, right? Fair to then ask you the cannibalization question as well. But at the end of the day, if I want to go to the market and buy an M&M vehicle, I'll think, I have to choose between ICE and your born electric range now. So will it kind of, one feed off the other to an extent? So in terms of volumes, as this starts scaling up over the course of FY26, what are you expecting in the SUV portfolio?
So if you look at the last 3 or 4 years, we've had some very good successes. And we've essentially been cannibalizing all our competitors' volumes, not our volumes. So some of it might rub off here as well.
Okay. But, the other excitement that the market has around this is that what it does to the overall margin profile. Anyway, you've had a great performance in the third quarter. Overall margins have been going higher. And these are coming at a very different price point, right? The electric vehicles, 25 to 30 lakhs, probably a new category of buyers also opening up. So on margins, as the scale-up continues on the SUV portfolio, or let's say the auto portfolio, not just SUV, what is the projection in terms of margins a couple of quarters down the line?
So margins will be slightly lower to start with, because you would expect that with a new product, also because it's electric. And we will be showing margins separately for ICE versus electric.
Okay.
And over time, they will catch up, because that's where the investments come in for. And we would expect margins to be similar to ICE in the longer run, but it will take us time for us to get there.
And what you described as longer run? I mean, just till this kind of evens out.
I think a lot depends on the level of demand that we see and the capacity utilization that we'll see, because that's going to be a key driver of that margin as well.
Okay, all right. Good to have you in the studio, Mr. Shah. Since you spoke about y'all are grabbing market share, I've observed that actually in all the three verticals. I think in tractors, y'all are at around 44%. In PVs, y'all have increased your market share. And LCVs as well. I think that's, came down a little bit in the last few years. It's back at around 45%. Could you tell us?
51.9%.
51.9%. All right. You'll pull back the margins, the market share out there. Could you tell us what is a sustainable number? Because I think tractors, it was in the low 40s, 40, 41%. Suddenly it's moved to around 44%. Do you think you could hold on to these numbers?
So we don't push for market share, especially when we are in the 40s and 50s.
Okay.
For us, it's more important to execute well. Okay. And the messages to the teams are continue to execute well on the ground, continue to provide the customer what they want, and market share will follow as a result. When we are in the low 20s as in SUV, yes, we are going for market share, and our products as they come out will gain more share. But that's a difference that we have in place.
So in SUVs, what would the target be then? PVs as well. And if I look at it as an absolute number, I think it was mid-single digits. That's moved to early teens. Where do you head out there?
So our target, and we have been fairly audacious in what we do, is to get to 40% in every segment we play in. So yes, we have a while to go, but that is part of the journey.
Okay, all right. Since the one that you're already at 40% is the tractors one, and that's where you'll have, hold of the market. And I was looking at a Jefferies note. They're saying that, the tractors market has seen a little bit of a lull, but now things are looking up. And I think you briefly mentioned that as well in your call. Do you think the tractors market now, the industry on the whole, is set for better times? And if that is the case, should we be looking at mid-teens growth for the next few quarters for the tractor industry?
So we do see a lot of green shoots in rural, as we've talked about earlier as well.
Yes.
For the fourth quarter, we expect 15% growth year over year.
Tractors.
And that's a very healthy growth in this space. For next year, a little early to say as yet, because it will depend on this particular season and how that goes as well.
Okay.
But overall, we remain fairly optimistic about where rural is right now and prospects for a tractor business next year.
Anish, let me pull back a little bit and we'll come back to individual segments, etc. as well. How important is this entire, how are you viewing all this tariff noise in that sense? So to narrow it down, I mean, there's been a lot of chatter that there could be some safeguard duty on steel, which could come in. And I mean, it's always, we start every Monday thinking, well, it's going to be this week. So who knows? But if that were to happen, especially on the tractor side, I mean, steel, I think, is by far the most important input, right? Does that as an automaker, does that impact margins a little bit? Will you be able to deal with it? Whatever happens. I mean, 10% is what is being spoken about. What's the sense?
So the focus on steel, as I understand it, has been specifically on dumping from China.
Yeah.
Dumping is clearly something important for us to take care of. But at this point, we don't believe it's going to go much broader and have a complete discontinuity in terms of steel prices in India versus the rest of the world. The reason for that is it will impact all the user industries and it will stoke inflation in a much bigger way. So it may take away a lot of the good work that's been done to create the demand stimulus because steel is an important material, not just in auto and tractors, but across many, many industries.
So it's about 7.5% right now. Say you slap another 10% on. So roughly 5,000, 6,000 rupees is what we're looking at. And it'll, as you said, affect everyone if that were to happen. But will that, you'll be able to sort of pass this on? What would be the strategy?
Typically, it would be passed on to consumers. Now, if you look at our overall consumption, 93% of the steel we buy is from within India. And most of what we buy is not manufactured in India today. So while it is, I think, absolutely the right thing to address dumping, as long as it doesn't change the dynamics overall, because that takes away from the whole Make in India story. Make in India means we've got to be able to produce in India at the lowest possible cost.
And be competitive.
And be competitive in that sense. So as long as we're competitive with global markets, I think we are in good shape.
What about...
So, since we're talking about passing on any potential duty increases to customers, if I could just bring in on the point on pricing, overall realizations were up around, I think, 2%. In the quarter gone by. The street might have sort of hoped for slightly higher. I think you're at around 88,860 average, pricing, the blended that is. How much elbow room do you feel that you have in your different segments, if you go piece by piece, in tractors, in SUVs, in LCVs, to take price hikes going forward? There was one in December, but what's the projection now looking at this year?
I think a lot depends on each product, each segment, each geography. So it's not something I'd look at overall. So
individually, if you could give us an individual sort of idea or an overview on these
I think segments. On a broader basis, there's some elbow room because we've been performing well across all our segments. Our capacity utilization still stays close to 100% despite tripling capacity in auto. So from that perspective, I think we are a little better placed on that front.
More elbow room in tractors or in the auto segment to hike prices?
I think that's a conversation we would have once we need to do it. Okay. At this point, we don't see the need as much. But if that does come up, then we will look at it.
Anish, just to finish that tariff point, Prime Minister Modi is in the US meeting President Trump. How important is that going to be? Because there's all this talk of reciprocal tariffs. What would you watch out for, really, in that sense?
I think it's an important relationship for us, and the US has been a key partner for us in many ways. The one advantage, in a sense, India has, which is not a great advantage to have, is that we haven't exported a whole lot compared to other markets. So from that standpoint, we will not get hurt as much by tariffs. And therefore, this is the time for India to really focus on manufacturing and make in India. And as we do that, we will have more competitive products, and there are many markets around the world where we can send them to. This is where FTAs come into play as well, and I know the government is pushing that in a much bigger way. So overall, I think the US relationship is an important one, and from that standpoint, I think this is an important week for us.
The Tesla question?
Exactly. I'm glad you asked that. I thought that has to come up in those conversations, right?
Do you think that'll be part of the, more access, lower duties, lower tariffs, and how is the industry looking at that?
As we've always said, we welcome competition. We've gotten better with competition. And as you see our electric cars, in fact, when we had our launch, we had our car next to 5 major makers in the world, and we had media and analysts and investors drive all 5 cars. We had an external agency rate all 5 cars. That included Tesla as well. And we came out very well. So we are happy to have competition in India. It will help the electric segment grow as well. The key for us, as we've always maintained, is that what we've seen the government do is take all actions that essentially foster make in India. That's the most important part. If India becomes a dumping ground for the rest of the world, whether it's in steel or automobiles or anything else, that's going to be negative for the economy. So as long as every maker in the world is making in India, that's a better outcome for us.
So, I'm just rounding off with, I'm reading out a brokerage note. Those are the tall expectations the street always has from M&M, and you've been delivering. This note talks about a CAGR of 15% at the top line, maybe 19 to 20% at the EBITDA and the PAT line over the course of the next 2 years. Doable?
So I just want to first say that M&M actually plays in 70% of India's growth, not just in auto and tractors. In fact, if you look at our services businesses, they've contributed very significantly over the last few years. And in fact, based on the data we've shared, they actually had more cash generation than either auto or farm. So that's what's been driving our growth. If you look at numbers for this quarter as well, Tech Mahindra Finance, our growth gems, have all contributed in a very significant way. Mahindra Finance up 47%, our growth gems up 33%, Tech on a good margin expansion path. So all of those things are really what's driving M&M forward.
All right, Anish, a lovely chat, great conversation. More questions, but we'll save it for the next time. Thank you very much for dropping by. It's always a pleasure to have you with
Likewise,
us,
thank you.
In the studios. Well, that's the top boss at Mahindra Group with perspective on growth path from here, and of course a little bit about all the noise around tariffs, etc. as well. So more competition welcome, but sell in India if you make in India. At least that's essentially been the government's thrust focus. And, he hopes that continues. We'll take a quick commercial break here. Markets down 120 points. A quick programming update. The Axis Capital India conference gets underway tomorrow. And we get you the top management of Axis Capital. It's a special edition of Market Masters. 10:30 a.m. You'll hear from Amitabh Chaudhary, MD and CEO at Axis Bank. Neelkan Mishra, Head Global Research, Axis Capital. Atul Mehra, MD and CEO at Axis Capital. So that's coming up at 10:30.
Welcome back. Well, the next company on our radar is Tech Wabag, and remember they won that big order in Saudi. To understand more about this order, we're joined by Mr. Sitaraman, the Chief Financial Officer at the company. Well, congratulations on this order win. We'd like to understand a few more details, sir. If you could tell us, out of this 3,200 crores approximately, what is your share in this order? By when do you start executing this, and what is the quantum of this order? Please go ahead.
Very good morning to you and to all your viewers. Thank you very much for having us on your show. Yes, this is a very significant order for Tech Wabag. This is a consortium order of 371 million, or in INR terms about 3,250 crores. And Wabag will execute about 1,700 plus crores out of this order. So this order is basically towards constructing a 200 MLD sewage treatment plant with the state-of-the-art technology and the associated transmission and delivery facilities like the pipeline and the reservoir. So we are the lead member of this EPC consortium. So we will be the technology leader. We will design, construct the sewage treatment plant, while our civil partner, MGC, will do the pipeline and the reservoir, which is more the civil part of the order. So in terms of quantum, this is one of the largest orders in our history. Very good reference also in the region, especially coming after Marafiq, after Jeddah orders, which we have now already delivered. This is a very advanced wastewater treatment plant, which will be a reference in the region.
Okay, all right. Mr. Sitharaman, the street reads this as good news because in December, when that earlier contract was cancelled, everyone got very nervous and there were questions being raised on the capability. But this order win seems to have soothed the nerves. So 1,700 crores is that one number that we have got from you in terms of your share of this order. Give us a few more details. What is over how many years does it get executed? FY26, what kind of revenue number will reflect? And over how many years do you spread this out? Also, what kind of margins will you be receiving on this particular order?
If I may take a moment on the earlier order, it was not the contract that was cancelled. It was the tender that went for re-tender because the client wanted to change specifications. That tender is also out now. I just take this opportunity to also inform all your viewers and the investors who are watching that the tender has been re-announced now and we are already working on it.
So let's, before we get to the answering the previous question, let's address this then. What is the quantum of, by when do we hear about this tender that earlier got cancelled and now, in fact, it could be, offered for rebidding? By when do we hear this, and will the quantum be the same? This is of the tender that got cancelled earlier.
Yes. So the tender has already been re-announced now. As we speak, we are working on the bid. And if I remember right, maybe about 4-6 weeks, in fact, 8 weeks would be the time likely to submit the tender. We'll come back to you with the exact date, but we want to confirm to you the tender is already out. We are already working on the tender and we will submit it. So there is no question of capability related. It was only a customer's decision to recast the project. And because it was a public procurement project, they could do it only through a re-tendering process.
So we have got that out of the way. In the next 8 weeks, we'll hear from you on that and we re-invite you on the channel and we'll clear out about the potential new order that you could win since the tender has been reissued. Great. Let's talk about this one, the 1,700 crores. Over how many years does it get executed and the margins?
This is about a 28-30 month project. Of course, this project is through a developer consortium, as you know. Miyahona, Basics and Marafiq are the developers for this project and we are in the EPC consortium. We are building for them and the principal off-taker is SWPC. The project had to cross through certain CPs for the EPC to become effective. So the financial closure was completed and hence we could announce the project to the market. But we have already started working on it because we were confident of the order. We've already announced it as a hot project in our organization. Teams are deployed. There's already people working on the engineering. So we have already had some heads up in terms of the activities and the activities.
So Mr. Sitharaman, sorry, we're just trying to understand the revenue recognition timelines. The overall value, your share is about 1,700 crores, like you explained. By when do you book it? Over how many quarters, and when does it start to reflect in the P&L?
this will start reflecting right from this quarter because we've already advanced on engineering. So you will start seeing the revenues flowing from this quarter, but the next 2 years will be the significant years in which the revenues will pan out.
So along with this order, I mean, where will you end the year in terms of order book? I think you were over 14,000 crores. Now this win has come in. You're talking about the other, rebid that could happen in the next couple of weeks as well. I'm not sure this fiscal or whether it falls in the next one. But where do you see your exit order book at for FY25?
See, at the start of the year, we guided somewhere around 16,000 crores. And we have seen that all the orders that we have targeted are moving in the right direction. And directionally, we are still endeavoring to get to that, Surabhi, because we don't see anything untoward at this point in time. Things are falling in place. Orders are coming out, especially international is what we targeted. So we are moving in the right direction towards that.
Mr. Sitharaman, morning. Could you give us a sense on margins from here? Where will margins be?
See, I think we've given this medium-term outlook for a 3 to 5 year period, with EBITDAs being in the range of 13 to 15%. This is the first year of the outlook, and we have seen in the 9 months we are about 13.5% on EBITDA, and PAT is over 9.2%. So that's the range we are comfortable with growth, and we will continue to maintain it consistently over this 3 to 5 year period and endeavor to continue growing it.
And revenue growth as well, give us a sense?
15 to 20% is what we had guided. We are very, very confident of that over the 3 to 5 year period.
Okay, all right. Interesting space, water, and markets has been very excited with VA Tech, of course, is one of the players in that space. Thank you very much. More later, but good luck as you continue to execute. Stocks up about 6%. Manisha joins us with commodities in focus on the other side. Okay, welcome back. Let's just get a quick view on the market, which of course continues to struggle a little bit. Mitesh is back with us. Mitesh, price action so far and fresh trades?
Yeah. So Prashant, I think, we talked about 23.4, 23.80 as the area. We got right there. I think the low for the day for the time being is 23.403. I was talking about the fact that we have maintained a long bias. We had some long positions as well on the call spread side, and we have added on to them. I still believe that 23.380 as a level could hold, and we might not get a close below that. So maintaining that positive stance going ahead. For the time being, I have one buy and one sell call. On the buying side is Hero Motors, which I would want to buy once the stock price is above levels of 43.25. It's made a high of 43.20 today. So that's the breakout pivot. Above that, buy with a stop at about 42.70 and a target of 44.50, 44.60 is what I'm looking at. And on the sell side, I have is Bank of India, which I would recommend selling with a stop at about 107.5 for targets of 100.
Okay, all right. Mitesh, thank you very much for that. So more trades later, but that's it for now. Let's focus on commodities. Manisha is here with what she's focused on. Manisha, morning.
Morning, and thank you for that, Prashant. But I'm looking at metals as a sector where we have seen the morning start with some gains here, even as the dollar index has been on the higher side. The street clearly is looking at more tariff concerns. Trump has said that they will introduce new 25% tariffs on all steel and aluminum imports. I mean, and this is specialty aluminum, steel, etc., which is used in various sectors, so markets really getting worried about that. Apart from that, today is the day that China also follows up with the retaliatory 10% tariffs on some goods coming in from US. So this is the tariff war that we've been talking about since the beginning of this year, and the markets have started to take impact on that. I want to start with copper first because we're trading at a 4-month highs onto this one. If you look at the previous week, copper gained up by 7%. In this year, until now, we are up by 15.5%. And the kind of gains that copper has put out from the previous week has been the best weekly gain since the month of September. On LME and Shanghai, we are looking at the copper prices continue to gain up quite strongly. Well, apart from the tariff concerns, it also is a statement that came out of Chile, where they say that they're looking at tightening supply concerns going forward in the global markets. And as far as demand is concerned, there is a strong one that's coming in from energy transition and also electrical sectors there. So that is a supportive factor there. If you look at the prices in 2025 till time, I'll start with gold yet again because we're trading at an all-time highs in the Asian markets here. For the Indian markets, 85,500 per 10 grams is where we are right now. So with nearly 10 to 12% of gains for gold. Silver prices trading at a 4-month highs right now. We are 11% up for this year for this. Copper, as I told you, 15.5%. So within commodities, copper clearly seems to be taking the markets on the higher side and outperforming as well. Steel and aluminum prices up by 3 to 5%. Zinc, which gained up by 14% in the previous year, hasn't done well for this year, down by 4%. So barring zinc and barring lead prices, everything in metals, precious and base metals, is doing quite well. Okay, all right, got that, Manisha. Thank you very much for a roundup. We do have to take a break right now, but on the other side, our special segment, It's the Economy, is coming up. Lata today speaks with Suresh Ganapathy of Macquarie Capital on the RBI policy impact on banks and NBFCs.
Welcome back. The Reserve Bank of India cut the repo rate by 25 basis points, which will impact banks because of the loans linked to repo. This may actually be at an advantage for NBFCs because they borrow from banks at loans linked to the repo rate. Now, to discuss the full impact of the Reserve Bank's various policies, as well to discuss the key takeaways from the Q3 results season, which for the banking sector has just ended with SBI announcing late last week, I have with me banking expert Suresh Ganapathy, Managing Director and Head of Financial Services Research at Macquarie Capital. Good morning, Suresh. Thank you very much for joining us. First up, at the end of the policy, do banks look far better?
Yeah, definitely. The fact that the RBI governor very clearly said that some of the implementation of the norms like LCR and ECL could be at least delayed for a year gives them a little bit amount of breathing space. And the fact that you have, of course, cut rates and the kind of liquidity infusion which has been done clearly means that at least next year things look to be slightly better on the liquidity front. And therefore, as an overall financial ecosystem, I think the policy was a step in the right direction. An overall positive, I would say, for the entire financial system. Of course, we'll come to implications of repo rate cut on banks, but I would read it pretty positively.
Okay, no, if you can make it bank-wise, I mean, who gets hit more because they have external benchmark-linked loans, or who get advantaged because liquidity, at least the governor's promises that he will keep it plentiful, who would have gotten impacted because of LCR rules?
Definitely, the LCR rules are going to impact the private sector banks more positively because of the fact that they have been running at a very high levels of LDR, and in general, the liquidity tightness has been there in them, and therefore they, of course, also have been growing the balance sheet much faster than the public sector banks. I'm talking about both on the loan growth and the deposit growth. So any relaxation on that front is going to be positive for the private sector banks. A relaxation on the ECL front actually is positive for the public sector banks. As far as the repo rate cut is concerned, Lata, I think we have to understand that the entire rate cut cycle itself is going to be a pretty shallow rate cut cycle. So to that extent, the benefits that you feel would accrue to the NBFCs because of a falling rate environment, or conversely speaking, the fact that the margins could be under pressure because of a cut in the repo rate is actually slightly exaggerated, because what we are talking about is a cumulative maybe 50 to 75 basis points cut in rates, and that too will happen in stages. And roughly what happens here is that the total MCLR, we also have to consider MCLR because eventually that also will be cut. So both repo plus MCLR roughly put together is anywhere between 65 to 70% at a broader system level, with PSU banks slightly at the higher level. So while there could be to some extent, in our view, anywhere between 10 to 20 basis points compression in margins next year, it could also be offset by the fact that Lata, loan growth has been pretty weak. Unsecured loan growth has been running at about 10-odd%. That will go to 15-16%, thereby cushioning the margin. So net-net, if I were to really look at the different drivers of margins, I don't expect more than 10 to 15 basis point compression in margins for the sector because of the RBI's cut in repo rate.
Okay. All right. Get that point. It will be countered. You know, the SBI chairman spoke to me after the policy, and he thought that deposit rates are not going down for at least a couple of quarters. Definitely not this quarter. It may take even longer, he thought. Right. So, you know, therefore, the negatives will come first for the banks before the positives come. Let me get to the results season as well. You know, now that all the numbers are out, would you want to think back and say which ones stood out for you? I mean, in terms of deposit growth, for instance, now on hindsight, HDFC Bank's performance looks very good. You know, SBI has been able to manage only 9% or 9.3%. HDFC managed big double digits, you know, 16%. High teens, 18%. So anyway, looking back, what stands out in terms of performance?
Yeah, so let me try to split in two parts. One is, of course, the overall balance sheet growth perspective, and also obviously with respect to the asset quality front. I mean, look, very clearly, the public sector banks still continue to have exceptionally low levels of credit costs, right? I mean, if you look at SBI and BOB's numbers, you're running at really low numbers. SBI was at about 23 basis points for the quarter. whereas the private sector banks are anywhere between 50 to 75. So on the asset quality front, the public sector banks are clearly outscoring because the component of unsecured loans in them is much smaller compared to the component in case of private sector banks. But the area where the private sector banks are doing really better compared to the public sector banks is on the balance sheet growth perspective, specifically on the deposits front, where clearly the public sector banks continue to lose steadily the market share. And again, another area where the public sector banks are not doing as well as the private sector banks is very clearly on the margins front. Now, the reason why this is important is because, as you know, the repo has been cut. So there is a downward bias to margins, although I say that it's going to be limited. But even at really rock bottom levels of credit cost, the ROAs for the private public sector banks at best are at 1%. So the real problem here is once the credit cost starts normalizing with a slightly downward pressure on margins, clearly the ROAs for the public sector banks would be at a greater risk compared to private sector banks going forward.
Okay. What would you say is the impact of the budget? See, we are talking about margins. That is the price per loan or the profit per loan for a bank. But won't the number of loans increase because every one of us have about 60,000 to 1 lakh rupees more? So won't you, if you're planning an EMI of, say, 90,000 rupees, you will push it to 1 lakh because you have 10,000 more. You don't see loan growth. After all, isn't 11% loan growth a nadir?
In that 1 trillion rupees, people will eat pizza, people will buy a lipstick from Nykaa, people will buy cars, people will save money.
No, I'm just asking whether loan growth numbers you are, pushing up.
Yeah, I mean, look, let's put it this way, that if the constraint for the loan growth in the near term always is going to be deposit growth. I know the economists argue that it's loans that create deposits and all those stuff. But at the end of the day, we also have to understand that the Reserve Bank of India has been to some extent, at least till last year, was shrinking the balance sheet. Yeah. Now, of course, they have cut the CRR. So there will be a money multiplier. Money multiplier, as you know, is 5 times. So a 0.5% cut in CRR will have a 200 basis points improvement in deposit growth. Of course, you've started doing OMO after, 3 years, 4 years. So there is obviously an expansion of the RBI balance sheet, which will have a better deposit growth. And eventually, the loan growth should also be better. I mean, the Reserve Bank of India governor very clearly also told about the fact that he's comfortable with the current growth in unsecured loan growth. And that need not come down. In fact, on the contrary, the unsecured loan growth can go up a little bit further. So the way we are looking at here is, we are at around 11% loan growth and 11% deposit growth so far. We will end the year with almost similar numbers. Next year, at least, we expect 200 to 250 basis points better loan growth, driven by some of these consumption-related aspects. And also, at the end of the day, the deposit growth should also be relatively better by 200 basis points. You're looking more like a better 13% kind of an environment next year compared to 11% this year.
Okay, so as a bottom line, looking at the results so far of the banking sector, and the budget and policy takeaways, what is your order of priority in terms of bank buys?
Yeah, look, so FY26 will continue to be a better year, in my opinion, compared to FY25, despite the margin compression because you have a better loan growth, better liquidity environment. And credit costs, at least for the private sector banks, second half of next year should start coming down, because all signals are pointing towards almost plateauing or peaking of the unsecured loan stress, right? So somewhere down the line, a couple of quarters, we will see a decline in the credit cost. So my picks very clearly would be a little bit more biased towards banks over NBFCs, and within banks, the private sector banks. I mean, some of these guys are indeed trading at a very attractive level of valuations on an FY27 basis for a 16-17% kind of an ROE. So I would follow a little bit amount of a barbell approach here, Lata. So on one hand, you can have really good quality ones like the likes of HDFC, ICICI and Kotak. And at the other extreme, you can really go for a low valuation bank or an NBFC like IndusInd Bank or Bandhan Bank, which are trading well below book. And you know that next year, at least the unsecured loan cycle should be relatively better, including the MFI space compared to what we have seen so far this year.
Okay, got that. But why are you saying banks over NBFCs? Wouldn't NBFCs find wholesale borrowings cheaper? After all, sovereign rates have crashed.
Yeah, but you have to also understand, Lata, that the overall quantum of rate cuts itself is going to be limited. So while when rates went up from 4 to 6.5%, On the way down, we are looking at 6.5% coming down to 6%, and NBFCs borrow 50% from the banks, right? So the extent of benefit that the NBFCs are going to receive on the cost of funds, this cycle will be limited is an important point which we want to drive across. And secondly, Lata, I do believe that the growth this cycle for the NBFCs, specifically on the consumer retail front, would be relatively lower because, gone are those days when you grew 25 to 30% when unsecured loan was growing at 30%. While unsecured loan growth will pick up, you're not going to go back to the 25 to 30% kind of a range. So you're looking at a slightly lower loan growth environment in the next 2-3 years for NBFCs compared to what you saw in the previous 3 years. So those are some of the two important considerations which makes us a little bit more guarded on the NBFCs compared to the banking space.
Okay. I'm not getting to the insurance because it's another vertical and I'll invite you on another day. But if you can speak about fintechs, Paytm, PB Fintech, actually that's a category by itself. And then you have even the small finance banks, the ones that we didn't discuss. Anything in that space that looks good? I mean, grow the whole range of fintech.
Yeah, see, PB Fintech, of course, is corrected quite sharply of late, yes. And their numbers have been pretty strong. I mean, they clearly have a path towards profitability. You can see that in the strong revenue growth numbers and also in the operating leverage numbers. While we do have an underperform on both Paytm and PB Fintech, I think there are, of course, some of these companies who trade at a very high level of valuation. So if we were to keep the valuation aside and purely focus on fundamentals, we do believe PB Fintech is slightly better. See, the problem with small finance banks, I do believe here, is the fact that the deposit growth environment still looks tough. So I think in an environment where I would take a call that deposit growth benefits that will accrue more to a private sector bank than to a small finance bank who have been either to relying heavily more on the bulk deposits market. They do have a large microfinance exposure. A couple of them may not be having that much. But remember that there is now a big question mark with respect to the business model itself, in a way that do you need to structurally pivot away from microfinance as a business segment? Because gone are those days where you used to have one bad year and 3 good years. Now it's looking like a one bad year, one good year. If that indeed is the case, you have to go more towards secured segments, which means lower growth, which means lower margins, lower profitability. And therefore, there is clearly a pivot of the business model, and that recalibration makes us a little bit more worried on the small finance bank as a space itself.
Fair point. No, I take your point. I believe even, there were news reports that the regulator is worried, but I couldn't check it personally. Very quickly, top finance sector buy for you.
Top finance picks, you mean to say?
Yes, pick.
Yeah, so it would be, as I said, HDFC, ICICI and Kotak. I'm sticking with the quality names at this point in time.
Okay, sticks with quality. Unfortunately, out of time, Suresh, always a pleasure having you with us. And thank you for this many splendored analysis of the financial sector. We have to wind up on Bazaar with the note that mid-caps are under serious pressure, and the pressure on even the big ones is not abated. It's still 0.75 down, a little better than 0.8 down, but really no relief coming up on any part of the market just yet. Wrap up on Bazaar on that slightly somber note. Hope Chartbusters, when it takes up the action, will have better news for you.